Hello everyone, I'm Rahul. Today I'm discussing with you the last part of the third chapter of the volume 2 of the economic survey, that is monetary management and financial intermediation. So let's move ahead. So last time we dealt with the financial inclusion and various reforms. So today we are going to talk about the reforms in the financial sector. First of all, what reforms have been done? The Forward Markets Commission has been merged with the Securities and Exchange Board of India. It happened approximately in September 2015 so as to achieve the convergence of regulation of securities as well as commutative derivatives. As you all know, this has happened after the lackadaisical approach of the Forward Markets Commission, as it was not able to gauge the crisis which happened or the scam which happened in the NSCL. Okay, so this merging has helped in increasing the economies of scope as well as scale for exchanges, financial firms and stakeholders. So the next reform is the monetary policy agreement has been signed between the government and the RBI. Everybody knows that RBI has decided to focus on inflation in this. So next reform is the government intends to do the following things. The first one is amend the RBI Act for providing the statutory monetary policy framework and monetary policy committee for taking the key monetary policy decisions. Okay. So, this will help in giving the structure or a mechanism by which the action will be taken in the in the result of the some systemic risk in the financial market. Similarly, the government intends to strengthen and upgrade the Securities Appellate Tribunal to the Financial Sector Appellate Tribunal. Now, what will happen is, previously, the Securities Appellate Tribunal is only seeing cases from the SEBI. So now it can see from all the various regulatory bodies. Now the other proposal is the creation of the Resolution Corporation to enable faster dispersal of deposit insurance. Now what do you mean by this Resolution Corporation? Resolution Corporation is for finding the solution to the various problems which are being faced by various institutions. For example, a financial institution is in a problem, so if it is, or a company is in approximately zero net worth, or it's going to be in the negative, so what the Resolution Corporation it will help in quickly shutting that down and giving the compensation to the various shareholders or loan givers. So this is the one of the recommendation of the Financial Sector Legislative Reforms Commission, or in short FSLRC, which was set up under Justice Sri Krishna. Now the next one is the orderly resolution of financial service providing company. Now what do you mean by this orderly resolution? It means that to declare and confirm that it is necessary to take specific measures with regard to a specific financial institution where there could be otherwise significant disruption in the financial system. This means that gauging the risk beforehand and taking specific measures for a particular institution so as to prevent the huge changes. For example, as happened in the financial crisis of 2008. Now, there has also been introduction of Insolvency and Bankruptcy Code Bill in 2015 in the Parliament. Now, this bill seeks to consolidate and amend the laws relating to reorganization and insolvency resolution of corporate persons, partnership firms, individuals in a time-bound manner for maximization of value of assets of such persons and to promote entrepreneurship and availability of credit. Also, it balances the interest of all the stakeholders, including changing the order of priority of payment to government dues, and also establishing an insolvency and bankruptcy fund, and all those matters related to it. So when our company gets insolvent in India, sometimes it takes as long as 25 years to close that company down and give the money to the people who have invested in that company. So this needs to be quickened up, and government has taken a step in this regard, though it needs to be seen when it will fructify. Uh, Also, I can give you a personal example that my father invested in some of these companies which got bankrupt, and the cases are still running in the Supreme Court and High Court, and the compensation is very meager as compared to what my father has invested. Okay, so let's move to the next slide. So in this slide, we're going to talk about the Financial Stability and Development and Council. So with the view of strengthening the and institutionalizing the mechanism of maintaining financial stability, that is, we should not have shocks like very quick changes in the exchange rate, very high debt. Also, we need to FSDC needs to enhance the interregulatory coordination. Interregulatory coordination means that various regulators like PFRDA, RBI, SEBI, and some other regulators all will be members of this FSDC, with the chairman being the finance minister. So if these members sit on a table and decide, so they can sort out the issues which occur between the regulators, because sometimes some fields overlap both the regulators and both give decisions on it, which might be conflicting. Also, the FSDC aims to promote the financial sector's development. Now, how this development will happen is that is through financial financial literacy campaigns, and financial involvement, financial inclusion of different people like Jandan Yojana, etc. Now, what does this council maintains? This council maintains, first of all, macro-prudential supervision of the economy. Now, what do you mean by this macro-prudential supervision? Macro-prudential means the approach to financial regulation which is aimed to mitigate the risk of the financial system as a whole. That is, it is not talking about the individual, but all of them combined. So that it talks about the systemic risk, as it is very similar to differentiating between the micro and macro economy. In micro, we have individual decisions which affect the micro economy, and in the macro, we have the decisions which affect the economy of a nation as a whole. Okay. Now, it also includes the functioning of large financial conglomerate. That is, it supervises the functioning of large financial conglomerates. Now, what are these large financial conglomerates? These are the corporations or financial houses which are engaged in different businesses that fall under a single corporate group. For example, they have multiple. For example, Reliance. What does Reliance? Reliance is in oil also, in communication also, it is in food processing sector also, and many other sectors. So it is a multi-industry company, or you can say it is involved in different fields. So the FSDC also supervises that, because it can have repercussions on the economy. Also, this FSDC addresses the inter-regulatory coordination and financial sector development, as I have already told above. And how it does is through financial literacy courses, as well as including people by opening their bank accounts, etc., and providing them the loans. Now, before coming to the insurance sector, I need to talk little about some decisions which have been taken by the FSDC during the various meetings, and these are macro in nature. For example, the meeting addressed the issues of corporate bond market development, which is very low. We have public bond or government bond market developed very properly, but not corporate bond market. Second one is the building effective deterrence in bank frauds. The other one is the non-performing assets of the banks, which are very high in the public sector banks. Also, we have stressed balance sheets of the corporate sector, and also the how to bring back the black money, and also the report of the Financial Action Task Force, and also follow up on the recommendation of the Special Investigation Team on the black money. Okay. So these are all the issues which the FSDC deals in under its macro aspect. Also, FSDC has a subcommittee which is under the chairmanship of the RBI governor, and these meetings discuss about the global and domestic factors which affect the financial stability, the RBI's financial stability report, the standards and protocol for setting up account aggregation for financial assets. What do you mean by this account aggregation? Account aggregation is a method which involves compiling information from different accounts like bank accounts, investment accounts, credit card accounts, and other consumers or business accounts in a single place. That is combining all into a single place and making the total amount. Also, these subcommittees discuss that whether it should allow insurance companies and mutual funds as protection sellers in credit default swaps. Now, what do you mean? What do I mean here is like the banks and other financial institutions give loans to the people or corporates, but they don't have any guarantee whether this loan will be repaid along with interest, or the principal amount will be repaid along with the interest. So what they do is they enter into a credit default swap agreement with the insurance provider. So it is kind of an insurance only, because you buy a insurance, kind of insurance, which we are calling here is credit default swap. If the client defaults on credit, so the insurance company will pay the bank the same money which the client had to pay under the loan agreement with the bank or any other financial institution. So actually it is taking the risk of the bank in return of premium which the bank have to pay to the insurance company every year. Okay. So the subcommittee also discusses about the corporate bond market development in India. So let's move ahead to the next slide, which is deals with the insurance sector. Now, the development of insurance sector, what we see through is we see through the insurance penetration as well as the insurance density. Now, insurance penetration in India is very low. That is 2.7% of the GDP. Now, what is this insurance penetration? It is the amount of premium volume as a ratio of GDP. That is how much premium the total population pays to the total of GDP which India has. So it is only 2.71% in 2001, and it has risen to 3.3%. That is, if a person is earning 1 rupee, he is only paying approximately 3 paisa towards the premium. Okay. Now coming to the insurance density. Insurance density is the ratio of premium to the population, which is per capita premium, which gives us per capita premium. When you divide total premium by total population, obviously it will give you per capita premium. It was only US dollar 11.5 in 2001, and it has risen to $55. So it has approximately 5 times increase in these 13-14 years. Now, globally, insurance penetration and density was 3.4% and US dollar 368 in the life sector segment, life insurance segment, and for non-life segment it is 2.7% and US dollar 294 respectively. So India is lagging behind the global averages of insurance penetration and density. Now talking about the claim settlement ratio and claim repudiation ratio. Now, what do you mean by repudiation? A repudiation ratio is a measure of claims rejected by the insurance company. Now, insurers always play this game that they show the claim settlement ratio specially, and they boast that they have very high ratio of 99% claim settlement. But the problem is you should never see the claim settlement ratio but the claim repudiation ratio. Now I will tell you what do you mean by claim settlement ratio. Claim settlement ratio is the number of policies settled by total number of policies. And as you know that very few people claim their policies, so it goes in the ranges of 99%. That is, claim settlement ratio goes in the range of 99%. But claim repudiation ratio, what do you mean by that? It is number of CRR, claim repudiation ratio. It is the number of claims rejected by number of claims made. Suppose total 100 people took a policy. 100 people took a policy, out of which 10 claimed. Okay, and the insurers rejected 3. Okay, so out of 100, only 10 claimed the policy, and so only 3 got rejected. So 97 by 100 will be claim settlement ratio. See, 97% it will come. But the claim repudiation ratio will be 3 by 10. Claims made were 10 and 3 the insurance companies refused to give. So 30% claims were rejected. So government insurers like LIC have a very good record in the claim repudiation ratio, as most of the times the claim is passed. But in case of the private banks like HDFC and ICICI, they have very high claim repudiation ratios, which means that they have many small words written in the end of the agreement of the insurance which nobody reads, and this leads to we get fussing, or we get entangled in these policies, or we get defrauded by these companies, and then when we go to claim the money, they refuse by showing the act of God, as you have seen in that movie. So let's move ahead. Now the government has started some new insurance and pension schemes. So these all were launched in 2015 for creating a universal social security system, when the government was criticized a lot because it was not doing much for the poor people. So the 3 schemes which are launched, first one was Pradhan Mantri Suraksha Bima Yojana. Now this is 1 year accidental cum disability insurance, that is accidental death cum disability insurance, which gives a disability cover of 2 lakh rupees to all those subscribers who are bank account holders and which are in age group of 18 to 70. And it had very low premium of rupees 12, which led to registration of lot of poor people too in this scheme. This is also renewable, which can be renewed later. So this will help in helping people who suffer from death or disability. Now the second scheme is the Pradhan Mantri Jeevan Jyoti Bima Yojana. This also a renewable 1 year lifetime cover of 2 lakhs to all subscribing bank account holders in the age group of 18 to 50 years. The third one is the Atal Pension Yojana, which was launched in May 2015. It provides a defined pension to the people depending upon their contribution and how long they have contributed. That is, how much money they have contributed and for how many years they are contributing, this pension which will be given after the retirement will be decided. So the subscribers to the Atal Pension Yojana will receive a minimum pension of rupees 1000 or 2000 or 3000, 4000, 5000 per month from the age of 60 years, depending upon their contributions, which are themselves dependent upon the age of joining the scheme. If you join much younger, you will be having more pension. If you join late, you will be having less pension. Okay. So let's move ahead. Now coming to the pension scheme. Now pension scheme, if we have to deal, we have to know the difference between the defined contribution and defined benefit based pensions. Now what is a defined contribution? Defined contribution plans are funded primarily by the employee himself, which is called the participant, with the employers matching the contribution to a certain amount fixed. A employee may elect to defer a portion of his total salary via a payroll deduction, that is deduction from the salary itself, and the company matches the same amount which the employee gives till a certain limit which the company has decided to give to the employee. Then these contributions which the employee is making is invested in various financial instruments like selected mutual funds, money market funds, and stocks, etc. So at the end of the day, as the employer has no longer any obligation on the account's performance after the funds are deposited, these plans are very low risk and requires very little administration on the behalf of the employer. Okay. So the government also seeing that everybody is every nation is shifting to the defined contribution based plans. So the government introduced the national pension system, which was also defined contribution based plan. So it has the objective of providing the old age income market based returns over the long run, so that the people have security in the long run. Now the efforts of the government are to widen the reach of the scheme beyond the employees which are within the government, because the government has only just started it. So not many people have joined it, because most of the people are still getting the pension from defined benefit scheme, and after 2004 only this defined contribution scheme came. Now what do you mean by this defined benefit schemes? A defined benefit scheme identifies the specific benefit that will be payable to the employee at retirement. So an employee's basic retirement benefit is usually based on formula that takes into account various factors like number of years a participant or an employee has worked for the employer, participant salary. So the retirement benefit is generally provided in the form of regular monthly payments over lifetime after the 60 years, 65 years, or whatever the age is of retirement. So this periodic payment is called pension or annuity sometimes. So this helps the older people sustain for the future. So there is more employer risk here, because an employer has to keep the money of the employer, has to invest so that to have adequate returns, so that the employer is able to pay the employee when the employer retires. So there is lot of administrative expenditure also on the behalf of the employer, and also it has to make many statistical calculations that where to invest, so that the employer is able to pay to the employee the defined benefit pension. Okay. So this has caused the problems for the employer. That's why the people are, or the people as well as the corporates as well as the governments are shedding this defined benefit scheme in the favor of defined contribution scheme. Now till 31st December, total of 1.12 crore members have subscribed to the national pension system. now and sorry, Atal Pension Yojana service providers have many financial institutions, which includes public sector banks, private sector banks, private sector banks, foreign banks, regional rural banks, district commercial banks, and this small corporate banks, urban commercial banks, and Department of Post. So these all serve the Atal Pension Yojana for the poor people or people who have very low salary and who contribute money in this scheme, and after the retirement they get the money based upon the number of years of the contribution as well as how much amount they have contributed. So thank you everyone. Please like, comment and subscribe to www.decipherise.com. If you like the lecture, please like our Facebook page as well as please do comment. Thank you.